Welcome to the deep dive. We're digging into some really game-changing news from Robinhood today.
Yeah, big stuff happening.
Definitely. You probably know them, right? The platform that really brought stock trading to, well, pretty much everyone.
Democratized access.
Exactly. And now they've just unveiled this major expansion in Europe. And get this, they're letting users there invest in things usually just for the super rich.
You mean the private companies?
Yes, like OpenAI, SpaceX,
Yeah.
alongside, the big U.S. public stocks, too.
Right.
So the huge question is, how are they actually doing this? And maybe more importantly, what does it mean for investing going forward?
That's perfectly put, because this Robinhood move, it's not just a new feature drop. It feels like a really pivotal moment.
How so?
Well, you've got traditional finance meeting blockchain tech head on. It looks like a very deliberate, strategic play to kind of reshape how global markets are accessed. So our mission today, really, is to cut through all the noise, all the headlines. We want to pull out the key nuggets of knowledge, the core insights from the source material we've looked at, give you a shortcut, basically, to understanding this transformative financial frontier.
Highlighting the opportunities.
And the challenges, too. Got to look at both sides.
Absolutely.
Yeah.
So our core topic for this deep dive, Robinhood's big strategic expansion into the EU and the EEA. We're focusing on these tokenized U.S. stocks and, crucially, the private company equity.
Yep.
We're going to try and unpack the innovation, navigate the pretty complex regulatory stuff that makes it even possible, and look at the market impact.
That's good.
Okay, let's dig in. So Robinhood has definitely made a bold entrance here into the European financial world, launching tokenized equities for UEE users.
It's not a tentative step, is it?
Not at all. It feels like a full-on strategic leap. They started with, what, over 200 U.S. stocks and ETFs?
Yeah, all the big names you'd expect.
Yeah.
Tesla, Apple, Microsoft, NVIDIA.
And the hook, the appeal, it's classic Robinhood, right? Commission-free trading.
Right.
Full dividend support, which is important. And those extended trading hours. 24 hours a day, 5 days a week.
Which is huge, and it really transforms their European app, doesn't it?
How do you mean?
Well, it used to be mostly just crypto over there. Now, boom. It's a comprehensive investment platform. It's a clear signal, a strategy to bridge TradFi and digital assets.
Makes sense.
But the really groundbreaking part, I think, is this venture into tokenizing the high-profile private stuff, OpenAI, SpaceX, for eligible EU users.
Okay, but how does that part work? Is it actual shares?
Well, this is key. Robinhood is very specific. They say these tokens provide indirect exposure.
Indirect exposure.
Yeah, it works through Robinhood owning a stake in something called a special purpose vehicle, an SPV.
SPV, like a separate little company.
Exactly. Think of it like a dedicated container company set up just to hold those specific private company interests. Your token represents a piece of that SPV, not a direct piece of OpenAI or SpaceX itself. Okay.
And that brings us right to the controversy, doesn't it?
Yeah, right into it.
Because OpenAI came out publicly and said very clearly, these are not OpenAI equity. They even added, we did not partner with Robinhood.
Right, a public disavowal.
And then Elon Musk jumps in, amplifying it all, saying, your equity is fake. Ouch.
Yeah, pretty blunt.
So here's where it gets really interesting.
Yeah.
What does this public skepticism, this pushback, actually mean for investors looking at these?
It means, I think, that clarity and transparency are just absolutely critical, non-negotiable.
So what was Robinhood's response?
Well, CEO Vlad Tenev clarified. He said, okay, maybe it's not technically equity in the traditional sense, but he argued they do effectively give retail investors exposure to the economic ups and downs of these companies.
So without the rights.
Exactly. That indirect exposure via the SPV means token holders don't get traditional shareholder rights. No voting, no direct claim on company assets if things go sideways.
Got it. And the market noticed this distinction.
Oh, yeah. The market reaction was fascinating. Robinhood's stock, HOOD, it initially jumped like 10–13%, hit an all-time high right after the announcement.
Wow.
But then, after OpenAI made its statement, the stock price dipped noticeably.
Interesting.
It really underscores how vital it is to have unambiguous disclosures. You absolutely have to prevent what regulators call material confusion among investors about what exactly they're buying into.
That distinction is incredibly important then. So let's pivot slightly.
Yeah.
Why the EU first? Why not launch this in the US, their home turf? Seems like a very deliberate choice.
Oh, absolutely deliberate. And honestly, pretty smart from a strategic perspective.
How so?
Well, the regulatory environment in the EU is just significantly more flexible for this kind of thing right now compared to the US.
Okay. What's the main difference?
A huge one is the lack of those strict accredited investor rules in the EU for accessing private markets. In the US, that's a massive barrier keeping most retail investors out.
Ah, right. The wealth or income requirements.
Exactly. Plus, the US regulatory scene is still, frankly, full of uncertainty around tokenized assets. It's just less predictable.
So Robinhood is lobbying in the US for changes.
They are, actively. But in the meantime, the EU basically serves as an effective regulatory sandbox. It's their primary entry point for this bigger global vision.
Using the EU to build a case for the US later.
Precisely. If they can demonstrate it works well, safely, and there's demand in the EU, it builds a really compelling argument for similar rules, maybe even a faster track back home.
That really clarifies the strategy. Okay, let's pull back the curtain a bit. Let's look under the hood at the tech. How are they actually managing these tokenized assets? What makes it tick?
Right. The tech is pretty sophisticated, and it's also evolving quickly.
Okay.
So for the initial launch in Europe, they're leveraging Arbitrum.
Arbitrum. That's an Ethereum layer 2, right?
Exactly. Chosen because it's faster and cheaper for transactions, which you need for trading.
Makes sense. But you said evolving.
Yes. Looking ahead, Robinhood has this ambitious plan to move everything over to its own proprietary Layer 2 blockchain. They're calling it Robinhood Chain.
Their own chain.
Yep. Built using the Arbitrum Orbit stack, so they're using a known, flexible framework to create their own custom chain. And it's being optimized specifically for tokenizing real-world assets, RWAs.
Optimize how? What features?
Things like wallet-native asset recovery, better smart contract interoperability, real-time bridging between chains. And strategically, they plan to control their own sovereign block space.
Sovereign block space. Meaning?
Meaning they'll run the sequencer. Think of it like the traffic controller or order taker for their blockchain. This lets them capture all the transaction fees directly. It's about control and revenue.
Okay, that's clever. Now, how are these tokens actually backed? You mentioned the SPV for private equity. What about the regular stocks like Apple or Tesla?
Good question. For the public stocks and ETFs, it's a clear one-to-one backing.
One token equals one share.
Exactly. Real shares are held in custody by a U.S. broker-dealer. They use what they call a token engine to create token wrappers around these assets.
Like a digital receipt.
Sort of, yeah, like a digital claim ticket for an actual share sitting safely in a traditional vault. When you buy or sell the token, a corresponding token is minted or burned. It directly links the digital world to the traditional market.
Okay, so that's pretty straightforward for stocks.
Right. And then for the private companies, OpenAI, SpaceX, it's that SPV structure we talked about.
Right, the indirect exposure.
Robinhood owns a stake via the SPV and issues tokens representing a claim on that SPV's assets. Again, indirect exposure, no direct equity, no shareholder rights like voting.
And so it's kind of a hybrid model.
Exactly. You've got centralized custody for the underlying assets, the real shares, the SPV stakes, but they're using blockchain for efficiency gains.
Like the 245 trading.
Right, aiming for 247 eventually, plus automated dividend payments, potentially even self-custody options down the road.
But it's not fully open DeFi, is it?
No, it seems more like a walled garden. They require know your customer, KYC, and anti-money laundering, AML checks. That suggests limited interoperability with the wider permissionless DeFi world. They're clearly prioritizing sticking to the rules.
Which makes sense, given the regulatory focus. So what's truly fascinating here is drilling down on those EU regulations. What specific frameworks are making this possible for Robinhood? It feels like they found a unique path.
They really have navigated it well. The big one is MiCA, the Markets in Crypto Assets Regulation.
MiCA, we hear that a lot.
Yeah, it's the EU's comprehensive, harmonized rulebook for crypto. It's set to be fully live in December 2024. And Robinhood Europe actually got the first EU MiCA license back on June 15th, 2025.
The first one. That's significant.
Hugely significant. It lets them offer crypto asset services across all 30 EU countries with just that one license, replacing older national ones.
And it tackles the accredited investor problem.
Critically, yes. MiCA's framework gets rid of those strict requirements for retail investors accessing things like private company investments, at least in this tokenized form. It's about democratizing access.
So MiCA isn't just rules, it's like a strategy.
Exactly. That's the key insight. It's the EU deliberately positioning itself as a global hub for digital finance by offering regulatory clarity while other places are still figuring things out.
Okay, what else besides MiCA?
Then you've got the DLT pilot regime. That started back in March 2023. Think of it as a regulatory sandbox specifically for DLT-based market infrastructures.
A sandbox, meaning testing ground.
Yeah, it offers temporary exemptions from some traditional rules like MiFID II to let innovation happen, but it has limits.
Limits like what?
Valuation limits on eligible instruments. For instance, shares tokenized under it generally need to be below a 500 million market cap.
So big private companies like SpaceX or OpenAI are way too big for that.
Exactly, which reinforces why Robinhood is using that SPV exposure model for them, rather than trying to tokenize their equity directly under this specific pilot regime.
Got it. Any other relevant rules?
Well, MiFID itself and guidelines from ESMA, the European Securities and Markets Authority, clarify when crypto assets count as financial instruments. They use a technology neutrality and substance over form approach.
Meaning they look at what it does, not just what it's called.
Precisely. So the EU's approach is proactive. It's a deliberate effort to create this harmonized framework, attract innovation, and lead in digital finance. It's not just looser rules, it's clearer rules.
Okay, let's connect this to the bigger picture then. How has the market actually responded to all this? And who else is jumping into this space? Is Robinhood running away with it?
Well, as we mentioned, Robinhood stock, A-SHID, had that initial surge, showing market excitement.
Right, then the dip after the OpenAI comments.
Exactly. It shows how sensitive the market is to legal clarity and, public perception. But interestingly, Robinhood's crypto trading activity, they're DARTs.
Daily average revenue trades.
Yep. Those jumped up by like 66.7% in May 2025. So there's clearly strong underlying demand for their digital offering.
And the potential market size in Europe?
It's massive. You're talking over 400 million potential customers in the UEA, many previously shut out from private markets.
So the benefits are clear. Zero commissions, dividends, 245 trading, fractional ownership.
Definitely compelling. And it feeds that democratization narrative. But again, it hinges on people understanding exactly what they own and what rights they have or don't have. Transparency is key.
Is anyone else doing something similar?
Oh, yeah. It's getting competitive. Robinhood's model is this synthetic exposure or broker-held token via SPVs. But you have platforms like Republic.
What's their approach?
They issue things called digital asset receipts, or DRs, which they position as representing true on-chain ownership, backed by equity, also with low minimums for private deals like SpaceX. So different models emerging.
And the big traditional players?
They're moving to Charles Schwab, interactive brokers, crypto exchanges like Kraken and Gemini. They're all expanding tokenized asset offerings, especially for non-U.S. investors.
The market growth projections must be huge then.
Staggering. For the EU tokenization market, forecasts suggest reaching U.S. $3.1 billion by 2030 globally. We're seeing figures like $2 trillion in 2025, potentially surging to over $13 trillion by 2030.
Wow.
Some reports go even higher, maybe $19 trillion by 2033. And specifically for real-world asset tokenization, maybe $500 billion by the end of 2025.
Those aren't just big numbers.
No, they signal an almost unstoppable shift. We're moving towards digital ownership, where traditional assets increasingly live on blockchains. It really forces you to rethink what owning something means.
And Robinhood wants to be the place you manage all that.
That seems to be the vision, this financial super app idea. One place for your stocks, your crypto, your tokenized assets, maybe even DeFi stuff. Supported by their crypto staking, perpetual futures, and acquisitions like Bitstamp. They're positioning themselves as a major contender.
Okay, with all this innovation and massive potential, it definitely raises an important question, especially for investors thinking about dipping a toe in. What are the big risks? What are the challenges Robinhood and others face here?
Absolutely crucial to consider. It's a complex landscape, and the risks are real.
Like what? What's top of mind?
First, those legal and regulatory ambiguities we touched on, the whole exposure versus equity thing is still front and center, especially after the OpenAI situation.
The lack of shareholder rights.
Exactly. That raises ongoing concerns about potential material confusion or even misleading marketing. Plus, those DLT pilot regime limits still mean high-value private companies like SpaceX, can't easily be tokenized directly as shares under that specific framework, hence the SPV model.
Okay, legal ambiguity, what else?
Second, technical vulnerabilities. Blockchains are powerful, but smart contracts can have bugs.
Exploits.
Yeah, code errors, malicious inputs, things like re-entrancy attacks, denial of service. We've seen huge financial losses in the wider crypto space from these kinds of things historically.
Can network issues.
Right. Blockchain congestion can slow things down, raise fees. There's still a lack of standardization between different platforms, creating hurdles for assets to move around easily. ESMA actually flags this interoperability issue, and smaller chains always have that theoretical risk of a 51% attack.
Where someone could potentially manipulate the chain.
Potentially, yeah, if they control enough computing power. Less likely on major chains, but still a consideration.
Okay, legal, technical.
Yeah.
What about market risks?
Third, operational and market risks. For less popular tokenized assets, you could run into low trading volumes, illiquidity.
Meaning it's hard to buy or sell when you want to.
Exactly. It makes price discovery difficult. And that 245 trading. While convenient, it also means more potential volatility for retail investors. Big price swings can happen while traditional markets are closed.
And AML/KYC.
Still a challenge. Despite MiCA's efforts doing robust cross-border markets, know your customer and anti-money laundering checks can be tough with blockchain's pseudonymity and tracing who ultimately benefits.
Right. And finally, investor protection.
Fourth, yes, investor protection concerns. This novel idea of exposure instead of direct equity just raises fundamental questions. What are your rights if something goes wrong? What recourse do you have compared to owning traditional stock?
Are the regulations helping there?
Well, EU rules like MiCA do aim to boost protection with mandatory disclosures and compliance rules. But the legal frameworks for actually resolving disputes involving these new kinds of tokenized assets, they're still evolving. They need more clarification.
So education is key.
Absolutely paramount. Comprehensive investor education on exactly what they're holding, the legal structure, the risks involved. That's essential for people to make truly informed decisions.
This has been a really, really illuminating deep dive. It feels like Robinhood's move into the EU is genuinely significant. They've cleverly used the EU's proactive regulations to get this first-mover advantage, offering access to assets that were previously off-limits for most.
Yeah, that super app vision, built on their own blockchain, it definitely positions them strongly.
But it's also crystal clear that this distinction between exposure and actual equity, especially after the OpenAI and Musk comments, demands absolute ongoing transparency. Investors need to know what they're getting.
Precisely. You know, the ultimate success of all this tokenized assets becoming mainstream, it really boils down to a few key things.
Which are?
Continued regulatory clarity and consistency, robust tech infrastructure that addresses those vulnerabilities we talked about, and, maybe most importantly, that comprehensive, ongoing investor education.
Trust and responsible growth.
That's the foundation it needs to be built on.
So it leaves us with a final thought, really. As financial markets keep tokenizing more and more real-world assets, what does it actually mean to own something anymore? And maybe, how much control are we, as investors, willing to trade for this newfound access? Something to ponder.